Aloha everyone, welcome to your retirement newsletter for Friday. And it's been a crazy week. I've had probably the most videos that I've released this week due to all the things that are kind of going on that I feel are important to talk about. I also am going to talk about some economic news that came out this week and also some data that I've been looking at to kind of, I guess, confirm or gain some kind of confluence as to why the market rallied so much this week. The market's up, a lot. And I think that we can kind of draw some conclusions and also get a feel of what is going on. And that I hope I can convey to you folks with screens and with talking. So I'm going to try and speak slowly so that we can kind of get, I guess, the gist of everything that's going on. And I'd like to thank Scott Ganis and his blog, as some of the charts we're going to reference are on the blog. But the first thing I want to talk about is the news. So on July 27th, that was Wednesday this week, we had the FOMC, and the Federal Reserve came out with this statement. Recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. They talk about the war on Ukraine as well as the federal funds rate. Now, the federal funds rate is now being targeted at 2.25 to 2.5%, which brings the federal funds rate increase for this next increase at 0.75 or 75 basis points. So what does that look like historically? Here is the federal funds target rate historically since 2006, and that will bring us right to the top of where we were before the pandemic. And that's what happened on July 27th. Now, what happened to the market on July 27th? We'll talk about that a little bit later. But next, the following day, another large, wonderful number, the GDP. And for those of you who don't know, gross domestic product for the US came in at a negative. It came in at negative 0.9%. What that basically means is that we are in a quote unquote recession. I use quotes because the White House has just recently redefined what a recession is. It used to be 2 consecutive quarters of negative GDP, but the White House has said that we're changing that. So here's Q1 and Q2 of the gross domestic product, and we are, as obviously it's a negative. We had that recession blip in the pandemic time, as we had a negative GDP at that point as well. What does this mean? Well, if you were to take the stock market's interpretation, it means we are going to the moon, because it went up. It went up like rockets. And what basically that kind of signals is that because we're in a recession, or because we were in a recession, we potentially now have the capability of having much better numbers. What do I mean by that? So this chart here again is by Scott Ganis. He runs a blog, and this chart of US real GDP versus the trends shows us that we had this trend line here at 3.1%, but our actual was kind of closer to this 2.2% trend line. And we just eked back right there recently. And this growth rate is actually healthy for our economy. And again, this is a logarithmic chart. For those of you that don't know, logarithmic charts, if it were increasing in a static line, it would be this a straight line, as like, if y were 1 or something, a straight line this way. If there's a slope, is an exponential growth, which is great as a tool to use to kind of evaluate how we should be growing all the time to provide for a healthy economy with a healthy inflation rate and a healthy productivity of the overall production of our country. So that's a good thing. Even though we're negative, we're still coming out relatively good because we're keeping up with the trend. Now the stock market, again, I would chart it out for you folks, but I don't want to bore you folks any more than you already need to be. But we did finish on the FOMC day up about 2.6%, and then on Thursday we finished up about 1.25% on the S&P 500, which means that even though we had negative outlook or negative FOMC meeting notes about inflation still running high, but we did have good numbers for unemployment and good numbers for kind of what's happening as far as a softening of this supply demand chain problems. And also with that, the interest rate hike only being 75 basis points, when I think in my other video I quoted that they may even push for a 1%. So because we didn't hit the 1%, and because unemployment is looking well, I think the market took that as a positive note because they had negatively priced in a lot of stuff, so it went up. Additionally, if you look here, this chart tells us the M2 supply, and the M2 is like that extra money that the Fed pumps into the market, that $4.4 trillion amount. And what recently the chart below has shown us is that the M2 supply has grown, but then we have taken care of most of that. Only about $1 trillion is left of the M2 funds, which has brought down a lot of the, I guess, future concerns of inflation, as people are just running out of money to spend on things. Most people don't have any savings anymore. They're not buying, unnecessary items. Consumer discretionary spending has been going down, which is pushing up again. I think I mentioned before in my other videos about inflation, how staple items have been shooting through the roof, right? 33% more on eggs, 15-20% more on chicken. Like, things are getting really expensive because people are now spending a majority of their money on things like staples, things that you need to eat, necessities versus discretionary, which is really showing us that a lot of that extra funny money has been sucked out of the system, which is a good thing. Now we just have to work on supply and demand chains and making sure that that can be at some kind of a balance, which I feel the economy will naturally trend that way, or at least constrict that way, based on regular human, just spending on things that you need versus things that you want. Interest rate wise, I'm not going to go over what these charts kind of mean, but just know that there's more of a healthy, I guess you could call it, capitulation or convergence of the rate, so that it's not so out of whack anymore. We are good liquidity, which means that we can buy and sell things at a relatively fair price, and there's enough market participation out there, especially in the bond market, where the US isn't having trouble offloading some of its debt. Other countries aren't having problems offloading their debt, of course, other than that one country. But other than that, we're doing relatively well. And I think that's why, fundamentally speaking, the market found some kind of good news when kind of everything else is negative. And we did have a lot of negative things priced in, and that's also why it kind of bounced up real fast. Now, I'm not sure what next week is going to look like. We do have still quite a lot of work to do to find a basing pattern for the SPY from a technical standpoint. We will have to find a better place to consolidate, because right here in the 410, 415 range, we had a lot of price action. So if we can find a basing pattern there and go up instead of down, that I feel would be a more significant move than the move we had this week, because it was so quick. Usually quick and violent movements to either side tend to have to consolidate, and then when it consolidates and we get a good basing pattern of prices, the price can move in either direction depending on what the overall trend of the market is, as well as economic factors and business factors that could push the market in one way or the other. Well, I think that's all I'm gonna say for today. You guys have a great rest of the week. Okay, be sure to check out the videos that I put out this week. I put out a video about Social Security, how it's calculated. You might have seen it in the last email that I sent you folks. It's really important just so that you can get kind of an idea of how the cost of living adjustment is calculated, so you can kind of put into your mind, it's not like some guess, oh, well, it's going to be. You have at least a good footing on how it's calculated, so you can make adjustments, especially when it comes to financial planning, on your income planning for retirement for the next year, kind of what things are going to be costing and how inflation really affects your Social Security income, and how you might want to plan on having more of your assets be heavily, or at least better, tied to inflation than you previously thought of, because we've been living in a world, or in a country, where inflation was so low for such a long period of time. If inflationary pressures do increase, you might want to consider finding inflationary protective investments, whatever that is. And I hope that this was interesting, as well as kind of educational. Again, I've been trying to think of things that would be more educational and entertaining, but it's really hard to find a mix of the two unless I start doing comedy, which, let's face it, I'm not that good at. So anyway, before I take up too much more of your time, I'll see you folks in the next video on Monday. We'll talk about things about Medicare. If you have any suggestions or want me to cover anything for retirement, Medicare, investments, whatever, let me know, and I will try my best to make a video for you. We'll see you there.